Hey everyone, welcome back. It's Rob with Perfect Spiral Capital. Today, we're going to look at something that a lot of people probably don't think a whole lot about, and that is what's the cost when they use cash? Now, most people are going to first assume that there is no cost to using cash. That's why they operate in cash. However, we need to think a little bit differently about that. So today, we're going to dig in, we're going to understand what that cost is or might be when a person decides to operate only in cash. So let's jump in and let's take a look. Let's say that you get a bonus, and because you're a highly productive employee and provide a lot of value back to your employer, or perhaps maybe you're a business owner and you've done a great job for your customers and you earn a $10,000 bonus of some sort. Let's say that you want to go on a trip to Hawaii or buy a camper with that $10,000. Have you ever considered what that simply buying the camper or going on the trip had a significantly different cost than just the price? In this quick example, you put in your time or your effort, you earned your funds, and then you get the item in which you earned. It seems great, you receive something of value for your money. However, as Nelson Nash teaches us in Becoming Your Own Banker, everything in life is financed. We either give up the future interest that our money could have earned, which is the general gist of our video today, or we have to pay, if we don't have the capital, we have to pay somebody else for access to capital in that situation. It brings up a great perspective of the cost of an item versus price. In our examples today, I want to challenge you to think differently and understand that everything in life is financed. We're going to consider that somebody could earn 5% interest uninterrupted, hypothetically, within a given account. We're also going to assume that somebody's 35 years old. In this case, let's say it's you, and you're going to have the opportunity to earn that interest over the course of the next 35 years. Again, this is just for the sake of example. Now, while we know that this tends not to happen in reality, we are going to use it as a baseline to get a better perspective about this price versus cost. On the surface, the price of the trip to Hawaii or that camper costs about $10,000. However, being that we are pretending that we're a 35-year-old, if that hypothetical account we just talked about existed, the real cost of buying that trip to Hawaii or camper was not just the $10,000, but also the $45,160 in interest we could have earned by age 70. This is exactly what I mean by the cost versus the price. And I know what's likely going through your mind though right now, but Rob, I still need to buy the thing. And I completely understand. It feels like we can't just save all of our money, but what if there was a way that we could potentially do both, or hypothetically be able to earn while we still spend? To make that happen though, we have to think differently. And to understand that, we need to be honest bankers. To truly be an honest banker, you should be saving that $45,160 we talked about that we gave up in interest over the next 35 years by spending that $10,000 up front. But do you begin to replace the interest that you would have earned or replace that capital that left your system? Most of the time, people aren't thinking that way. They're not doing that. Or perhaps maybe as we think about this system, maybe we should consider where money flows matters. Nelson Nash highlights that the process of banking, which most of us are not taught, is the flow of money at a cost. As we see in the example today, you, the hypothetical 35-year-old, have $10,000 flowing through our system. And that $10,000 is gone forever when we spend it in cash. It just flowed through our system. However, if we can control the flow of that money and where that money flows to first, it gives us an opportunity to potentially recapture some of that over time. Let's take a closer look at how we could flow that money differently through a system that we own and control, and perhaps retake some of that over time. Much like before, we start with our time being rewarded and we receive some money, that same $10,000. However, you are now a 35-year-old that was planning ahead and has a dividend-paying whole life policy from a mutual provider that's structured for the purposes of infinite banking. So first you flow your money into the policy that you own and control. Then you borrow against the policy for that $10,000 purchase and buy the trip to Hawaii or the camper or whatever else you were thinking of Since you are an honest banker, you determine to put your capital back that you used by repaying your loan. You also know that when you do so, that same amount of capital then becomes available to use again, and or perhaps will become available for some sort of an investment opportunity down the line. Here's another way to consider what's going on in our example to help change our perception a little bit. Let's think of our $10,000 in this example as going into the policy as paid up additional premium. That premium is going to really and should be thought of as capital creation, both current and future. It's also going to create new death benefit, and it's going to create future passive income via the guaranteed cash value growth and dividends in perpetuity until the insured passes away or the contract would endow at age 121. As I mentioned, when you take a policy loan in this case, which was to purchase a camper or take the trip to Hawaii, when you make those loan repayments, it should be thought of as a replacement of your own capital. That's part of what being an honest banker is. If we use capital or take it out of our system, we should be looking to put it back. And we should be trying to do that with interest. So even if we're operating in cash, we still need to operate and should be thinking about operating as honest bankers. And that means we look to replace any capital that has left our system in some way, shape, or form. The process is really no different than saving up to replace the $10,000 in cash that we already were spending anyway for the trip or the camper. Let's take a quick comparison between these items to help maybe recenter us and help make this picture become a little bit more real. Between these items, here's a table where we can see them side by side. For example, in the cash only column, we can see that somebody spends the cash and they get the item and that's about it. There really is nothing else. In the case of lost value of the cash, if the money went into this hypothetical account, they would earn $45,000 in interest over the course of those next 35 years. Now, what's interesting is if we think differently and we think about the process of infinite banking, if we had put the money into a dividend-paying whole life policy over the same time frame, it would have appreciated to $49,000 in cash value from the guaranteed growth and from the growth of the $25,000 in cumulative earned dividends, which were used to buy more paid up insurance, allowing that death benefit to grow for our children or spouse to $66,000 of that same 35 years. It's really important to note that in this situation, with the examples I just went through, I've isolated that $10,000 going into a policy. So it's really important not to think about it solely as that item because it can't exist that way naturally in life. You have to have a policy that it's a part of, plain and simple. So we'll get more into that in just a moment. Here's a graphed version that will help better illustrate the comparison between using the cash, putting the cash into an account and earning an uninterrupted 5%, and the specifically isolated performance of the $10,000 within that dividend-paying whole life policy at ages 36, 50, and 70, or 1 year out, 15 years out, and 35 years out. On the surface, it does kind of look like the 5% savings account, though it's not realistic, does appear to be the better option, but don't be fooled by what the unseen. Remember that if you pull that $10,000 out of that account at any point in time, none of this other situation actually exists. Not to mention an uninterrupted 5% savings account doesn't exist, and the fact that you would have to pay taxes on that growth. In the policy, you have access to that $10,000 as it grows uninterrupted. So as you pay that $10,000 back or replace that $10,000 in capital, remember you can use that again. And all the while it's continuing to grow. That cash value is continuing to grow. So that $10,000 doesn't just sit as $10,000. It continues to grow. It continues to expand. Knowing that there's access, how many times could you theoretically use that $10,000? 2 times, 10 times, 20 times, 35 times? It really depends upon each person's cash flow situation. All the while, though, that money is continuing to grow. As I mentioned earlier, it's really important to remember that these things don't happen in isolation. It is part of a larger policy. And that's what we see here in our next view, where we can see the blue bar with the original $10,000 applied within the base policy. You have you, the hypothetical 35-year-old who opened this policy to benefit your family in the future, and it's there to accommodate the 10,000, you can clearly see that the cash value available by age 50 in this hypothetical example would allow you to have access to nearly $101,000 that would allow you to finance many of the substantial items that come along in a lifetime. Not only is there that money by age 50, but the cash value accumulation by age 70, there's nearly $400,000 that you could use as a significant buffer as you enter retirement or your passive income years. Again, this does assume that someone had opened a dividend-paying whole life policy at some point in time. In this case, you wanted to be sure that no matter what, your spouse, your family was cared for with some death benefit in the unexpected event of your passing. And with a dividend-paying whole life contract from a mutual provider, that policy is guaranteed to be able to pay out and take care of that throughout the course of your lifetime, whenever that might be. Simply for reference only, I do want to show you a different look in how the addition of that single one-time add of the $10,000 impacted this hypothetical policy. You can see the significant impact that it had on the growth of the policy over the next 35 years, with cash value at age 70 growing to nearly $400,000. Had we not added the $10,000 over those 35 years, the amount would have only accumulated to $328,000, which really isn't bad by any means, considering the premium amounts that went in. Something that isn't shown here, however, is the death benefit. Over that same amount of time, that death benefit would have grown to almost $576,000 as well. So with the vast majority of that $400,000 in cash value being guaranteed at age 70, it provides a ton of options and a ton of security, not only for you, but also for your loved ones. Another thing that's really critical to think about here as well is that these types of processes, while we're talking about hypothetical $10,000, they also work well beyond that. So whether someone has maybe half the amount of funds available, or maybe they have 5 times or 10 times the amount available, these same processes and the same proportions generally hold true. Here's a quick example if we did a simple 5x on all the amounts, the base policy and the one-time addition. So going from $10,000 available to adding a one-time add of $50,000. And we can see that the same general proportions exist, but the numbers get significantly larger. In this case, $520,000 in cash value by age 50 and $2 million in cash value by age 70. Regardless of the amounts that you're talking about in your personal system, the principles of banking still apply. And where the money resides and the environment in which it's residing in all still matters. So to wrap up today, let's do a little bit of a recap and think about this process. We're talking about $10,000 hypothetically flowing through our hands, what the cost of that is over time. A couple of key points. One is that everything in life is financed, and we need to consider where the money and how the money is flowing through our hands over the course of our lifetimes. The second point is we need to create an environment in which we are in control of the flow of money in our lifetimes. And that means that we have a place where it can reside and be treated favorably. The last point here is that banking simply is. You, me, we're all bankers in some way, shape, or form. It's just that some of us have outsourced that banking function to a third party. And when we outsource that banking to a different party, we actually give up all the profits of that banking function to someone else. So by creating an entity in which we can retake that banking function, it creates an opportunity for us to recapture and retain some of that profit that would normally be gone or reaped by someone else. We can create this system or this environment or a place for money to reside and then allow us to control the flow of it over the course of our lifetimes. My hope for you today is that you actually were able to learn something in some way, shape, or form, or maybe it challenged you to think differently about using cash, what the cost of an item is. Regardless, I hope that it's something that you can use. If you'd like to explore this process and this concept a little bit more, I recommend getting a copy of Becoming Your Own Banker. You can check the show notes there, Or perhaps you want to check out some of my other videos. I have other content that kind of broaches into some of these topics. Or maybe you want to talk to me directly. I'd love to chat with you about it. I'd love to hear from you in the comments too. Either way, set up some time, comment, and let's talk more about it. Otherwise, thanks for watching and have a wonderful day.